What should you know about loans? Read carefully every article of the loan agreement. What is a loan? What kind of loan? Types of loan? Which bank? Documents you need to provide before you apply for a loan. Loan agreement, the principal amount, total amount repayable, the term, interest rate, effective interest rate, penalty rate, CRK classification, unilateral change of contract, collateral for the loan, early payment, grace period, installment, copies for client, and conclusion. Introduction. At some point of life, many people want to a house, a flat, a car, or to start a new business, but do not have enough money to carry out these activities. And one of the solutions that helps them solve these issues is to get a loan. What is good to know before you get a loan? There are certain things that one should know before applying for loan agreement for the personal finances of every person. Therefore, when taking important decisions, we need to have all the necessary information. Loan agreements should be designed to make every aspect of the loan crystal clear to the borrower. However, these agreements can be complicated and even confusing. Sometimes, if you are not sure what a particular part or a document means, then never hesitate to ask for explanation or assistance. Take your time as long as you need, but do not sign the agreement unless you know and understand every article of the agreement. Read very carefully every article of loan agreement. What is a loan? A loan is a debt, a sum of money provided to you by a commercial bank or microfinance institution now in order to repay it later with definite conditions on a specific term with an interest. After you get the above mentioned and information, you are ready to apply for a credit. When you get pre-approved, creditor reviews your credit income and assessed documents you need to provide before you apply for a loan. ID card, valid identification documents issued by the Republic of Kosovo, working contract, regular monthly payments, and additional documents depending which loan you apply for. Credit agreement. Credit agreement is an agreement where a creditor grants or promises to grant to a consumer credit in the form of a deferred payment loan or other similar financial accommodation. The creditor usually is a financial institution, commercial bank, microfinance institution, etc., licensed by the Central Bank of the Republic of Kosovo. Usual loan agreement consists of name, surname, ID of the consumer. The consumer is the person that receives value from the creditor on the condition that he will pay the principal amount plus any interest to the creditor. The creditor is the financial institution, commercial bank, micro credit institution, etc. Licensed by the Central Bank of the Republic of Kosovo that gives money to the consumer on the condition that the creditor will be paid a certain amount in the future. The principal amount, the amount borrowed, or the part of the amount borrowed which remains unpaid, excluding interest, is called principal. Principal is the original amount of the loan that is owed by the consumer to the creditor bank on the date the loan contract is signed. Once the consumer has begun to pay back the loan, principal refers to the amount of money still owed the creditor. Choose the bank that gives you the best offer. Purpose of these two regulations is to determine the unified methodology for calculating what kind of loan. The first step is to figure out what you need. How you get the loan will depend on the type of borrowing you are doing. Choose the type of loan that best first you need. Therefore, it is very important that you are determined for the proper loan that fits your need. Types of a loan, there are many types of loan, but the most usual ones used in Kosovo are personal loan, mortgage loan, business loan, consumer loan, overdraft, agriculture loan, education loan, etc. Which bank? Search all the banks licensed by the CBK and find out the terms and conditions which bank offers the that fit your needs. Check with several banks and compare interest rates and other costs. They can run some numbers for you and help you figure out exactly how much you can borrow. Sometimes also they offer their special rates, however you may or may not qualify for those. After you get the above mentioned information, you are ready to apply for a credit. When you get a pre-approved creditor, review your credit income and set comments you need to provide before you applying for a loan. ID card, valid identification, documents issued by the Republic of Kosovo, working contract, regular monthly payments, and additional documents depending which loan you apply for. Credit agreement. Credit agreement is an agreement whereby a creditor grants or promises to grant to a consumer credit in the form of a deferred payment loan or other similar financial recommendation. The creditor usually is a financial institution, commercial bank, microfinance institution, etc. licensed by the Central Bank of the Republic of Kosovo. Usual loan agreement consists of name, surname, ID of the consumer. The consumer is the person that receives the value from the creditor on the condition that he will pay the principal amount plus an interest owed to the creditor. The creditor is a financial institution, commercial bank, micro credit institution, etc. licensed by the Central Bank of the Republic of Kosovo that gives money to the consumer on the condition that the money creditor will be paid a certain amount in the future. The principal amount, the amount borrowed, or the part of the amount borrowed which remains unpaid, excluding interest, is called principal. Principal is the original amount of the loan that is owed by the consumer to the creditor bank on the date the loan contract is signed. Once the consumer has begun to pay back the loan, the principal refers to the amount of money still owed to the creditor. Total amount repayable in addition to the specified principal. The credit contract should contain the total amount for payment, loan value, and total cost related to the loan, including interest rates and fees. Loan prepayment is made up of two main portions: the principal, the amount you originally borrowed, and the interest calculated on the principal you owe, and it may also include fees. The term is the time length of the loan contract. At the end of the term, the full amount of loan must be repaid. The consumer must repay the outstanding balance of the loan to the term that represents the desired frequency of payments, 36 months, years. All banks have different offers for the term, therefore, and you can choose the institution bank that gives you best offer in this regard. Interest rate is the amount charged to the consumer for the use of creditor's funds. It is expressed as a percentage of the amount borrowed and is calculated as a specific interval over the course of the term of the loan contract. Interest rate can be specified either as fixed interest rate or variable interest rate. For variable interest rate, it is important to provide all necessary details on its variability. Effective interest rate. The effective interest rate reflects the full cost associated with the loan and should be clearly stated in the loan contract. It enables direct comparisons with other loan products and helps clients to understand how much has to be paid for the loan. Effective interest rate is influenced by many factors such as the nominal monthly interest fees and commission, the chosen repayment method, and the term of the loan. Detailed information on calculating methodology of the effective interest rate and definition of elements used for its calculation and determined by the sub-legal acts issued by the Central Bank of the Republic of Kosovo, who issued the regulation on effective interest rate and disclosure elements for commercial banks, and the regulation on effective interest rate and disclosure for microfinance institution. Purpose of these two regulations is to determine the unified methodology for calculation and disclosure of the effective interest rate on credits granted and deposits received, and the minimum disclosure requirements in order to provide full and accurate information on products and services that banks and MFIs offer for customers. It is very important to understand the difference between the nominal interest rate and the effective interest rate. As noted above, the nominal interest rate is a percentage of the amount borrowed, and it determines the amount of interest paid by the client is in monthly or annual installments, whereas the effective interest rate is used to present in a single figure all of the expenses associated with a loan. Thus, the effective interest rate also includes all of the additional cost of processing the loan application. It is taking into account the time at which these costs are incurred. Penalty rates. Bank normally charges additional fees for late debt service. The loan contract should contain details about such charges expressed as a percentage and the rules for its later adjustment and any other fees it applicable for late payment. CKR Classification Credit Registry of Kosovo. Before one gets qualified for a loan, creditors look at the customer's personal credit history, credit cards, mortgage payments, and personal bills to get a sense of their track record with financial responsibilities. In order to help the creditor is taking the right decisions with a shorter time in more accurate and more objective way, the CBK issued a regulation on credit registry based on which the CRK collects and distributes credit information between financial institutions for purpose of improving credit quality and performance of the supervisor function of the central bank. Based on this regulation, all lending institutions reports and may obtain a summary report on the level and status of active credit and history of each borrower upon a client consent. Unilateral change of contract. Banks may retain the right to make certain change in loan conditions irrespective of the client if these conditions exist in the credit agreement. The credit contract should specify which conditions and under what circumstances they can be changed. It is very important to understand the difference between the nominal interest rate and the effective interest rate. As noted above, the nominated interest rate is a percentage of the amount borrowed and determines of the amount of interest paid by the client in monthly or annual